I can't type too much. Just gonna do some video lectures. And let's do the introduction to financial accounting because I was quite interested in this topic ever since I got involved with the stock market. Oh, and don't forget to subscribe, comment, drop a like if you haven't. With that said, let's go.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to build on our discussion of the balance sheet equation to talk about assets, liabilities, and stockholders' equity in more detail. We're going to provide precise definitions for each of them, and we're going to look at situations where we can record them and situations where we can't record them. Let's get started. Let's start with assets. An asset is a resource that's expected to provide future economic benefits. That means it's either going to generate future cash inflows or it's going to reduce future cash outflows. There are two criteria that we use to decide when to recognize an asset. First, it must be acquired in a past transaction or exchange, and second, the value of its future benefits can be. So for example, if we buy a truck, the truck would be considered an asset. We acquired ownership of the truck in an exchange, and the value of the benefits of the truck are equal to the price that we paid to buy the truck, so both criteria are satisfied, and it would be an asset. Now we're going to practice applying these criteria to figure out which of the following items would be assets. I'm going to give you a number of items, and for each one I want you to try to figure out whether it's an asset or not. If it's an asset, try to give me the account name and what the dollar amount would be. If it's not an asset, then try to figure out what criteria would cause it to not be an asset. I'll bring up the pause sign, so if you want to pause and try to answer yourself, you can, but as always, you can just roll through and listen to the answers if you'd like. So let's get started. BOC sells $100,000 of merchandise to a customer that promises to pay cash within 60 days.
100K cash.
This will be an asset called accounts receivable. It's an asset because there was a transaction where we delivered goods to a customer, and in return we got a promise from them to pay cash. It's an asset because that can turn into cash within the next 60 days. And the value of the future benefits can be reasonably estimated because it's the amount the customer owes us on the invoice, and that amount is $100,000, which is what the value of the asset would be. Next, BOC signs a contract to deliver $100,000 of natural gas to DEF each month for the next year. This one will not be an asset because there's been no past transaction or exchange. Every exchange of cash, goods, or services is going to happen sometime in the future. Nothing has been exchanged yet, so there can't be an asset for it.
Excuse me. Both of these two sound like promises to me. Why is the first an asset but the second is not?
That's a great question. In the first example, the customer has promised to pay us cash, but we've acquired that promise through delivering them goods. In other words, there's been a past transaction or exchange, which is that first criteria for recognizing an asset. In the second case, all we've done is sign a contract. If the contract was broken, it's not clear we'd have any basis to ask the customer to pay us $100,000. So this first criteria, acquired in a past transaction or exchange, is there to raise our assurance that something that we want to call an asset is a legitimate resource that should deliver future benefits, as opposed to a simple promise that could easily be broken, as might be the case if there's a contract that was signed with no accompanying exchange of cash, goods, or services. BOC past transaction or exchange, which is that first criteria for recognizing an asset. In the second case, all we've done is sign a contract. If the contract was broken, it's not clear we'd have any basis to ask the customer to pay us $100,000. And so this first criteria, acquired in a past transaction or exchange, is there to raise our assurance that something that we want to call an asset is a legitimate resource that should deliver future benefits, as opposed to a simple promise that could easily be broken, as might be the case if there's a contract that was signed with no accompanying exchange of cash, goods, or services. BOC buys $100,000 of chemicals to be used as raw materials. BOC pays in cash at the time of delivery and receives a 2% discount on the purchase price.
The chemicals.
This is an asset, and we'll call this asset inventory. Inventory is a term that we're going to use for any product or raw materials that we buy that we're going to turn into a finished product that we're going to sell at a markup. It meets both criteria. We acquired the chemicals in a market transaction, and the value of the benefits is known here because it's what we paid in the market transaction. And note that the value here is $98,000, not $100,000, because we value it at what we actually paid for it, not some kind of higher sticker price that wasn't what the transaction actually happened at. BOC pays $12 million for the annual rent on its office building. It has already occupied it for 1 month.
11 million worth of rent.
This is an asset. We're going to call it meets the first criteria because in a market transaction, we paid for the right to occupy space in this office building. Benefits are also known. Note that at this point, the value of the benefits is only $11 million, not the $12 million that we've paid. Because we've already occupied it for a month, we've used up 1 month of the future benefits. So at this point in time, there's only $11 million of future benefits. So we have prepaid rent worth $11 million. BOC buys a piece of land for $100,000. Its broker said this was a steal because the land is probably worth $150,000.
Still 100 grand worth of land.
This is an asset, which we'll call land. Meets the first criteria because there was a market transaction where we acquired ownership. The value of the benefits are assumed to be what we paid for it, which is $100,000. Now note we ignore the last sentence about what the broker thinks the land is worth because that's not what we paid for it in a market transaction, and so we're not going to use that as the value of the benefits. We're going to use the more objective number of what we actually paid for it. So we've got an asset land that's worth $100,000. BOC is advised by a marketing firm that its brand name is worth $63 million.
63 million brand name.
This would not be an asset because we never acquired it in a past transaction or exchange. And you could argue that the value of the brand cannot be measured with a reasonable degree of precision, so it doesn't really meet either criteria.
Are you saying that marketing people do not know what they are talking about?
No. I definitely respect marketing people. Some of my best friends are marketing professors. It's simply a case where accountants have decided to err on the side of reliability or objectivity. Without a market transaction where the company has acquired the brand, we can't be sure of how much it's worth, and so we err on the side of leaving it off the financial statements. For this reason, you'll often see the value of the company in the stock market to be greater than the value on the financial statements because investors would consider this to be an economic asset, whereas the accounting system is going to ignore this asset as not reliable enough. Now we're going to turn to liabilities. A liability is a claim on assets by creditors or non-owners that represent an obligation to make future payment of cash, goods, or services.
My former boss called me a liability to the organization. Is this what he meant?
No, you were probably a liability in a different sense. Let's go on. Just like assets, there are two criteria for when we recognize a liability. First, the obligation is based on benefits or services received currently or in the past. And second, the amount and timing of the payment is reasonably certain. And even though the words are different, these are essentially the same two criteria for the assets. The first one says there has to be some kind of transaction or exchange where you've received something that creates an obligation. And the second criteria says you can measure the amount of what the obligation is. So for an example, let's say we borrow money from a bank. We have an obligation to repay the bank based on receiving the benefit of getting the money now. The amount and timing of the payment is reasonably certain, and if there was any question, I'm sure the bank would clarify how much we exactly owe them. So borrowing money from a bank would meet both criteria, and it would be a liability called something like notes payable or mortgage payable. We're going to do the same exercise now with liabilities. I'll give you a number of items. I'll give you a chance with the pause sign to try to answer them if you'd like, and then we'll talk about what the answer is. First item, BOC receives $300,000 of raw materials from its supplier and promises to pay within 60 days. This will be a liability. We're going to call this liability accounts payable. We use that term anytime we owe money to a supplier. It meets the first criteria because we got the benefit of raw materials in a transaction, which now creates the obligation to pay our supplier. And the amount of the obligation is reasonably certain. It's the $300,000, which is on the invoice. So we're going to have an accounts payable liability for $300,000. Based on this quarter's operations, BOC estimates that it owes the IRS $3 million in taxes.
3 million taxes. There's no transactions per se.
This will be a liability. We'll call this liability income tax payable. It's a little bit hard to see the first criteria here because there was no explicit transaction. But essentially what happened is the government allowed us to operate our business
in the country.
so we got the benefit of being able to operate our business in this country. And in return, it created an obligation to pay them taxes based on the right to operate the business. We have to then estimate the amount of the liability. Even though we don't know exactly what the taxes are at this point, we can estimate them with reasonable certainty. We come up with $3 million as our estimate, so we would have a liability called income tax payable for $3 million.
You said that the amount and timing of payment has to be reasonably certain for there to be a liability. Why is an estimated amount considered to be reasonably certain?
We're going to have to make a lot of estimates in accounting. As long as we're reasonably certain about the number, we should go ahead and book the liability. For something like taxes, there are tax forms available on the web. We have a rough idea of how much our taxable income will be during the period, and so we can estimate what our tax liability is. Now, it may not be 100% correct when we eventually file the form, but whatever our best estimate is a much better estimate than ignoring it completely. So we go ahead and put our best estimate on the financial statements. Next, BOC signs a 3-year, $120 million contract to hire Dakota Dokes as its new CEO starting next month.
You have to pay the salary.
This one is not a liability, and it's not a liability
But you haven't
because
received service.
there's no obligation based on benefits that have been received currently or in the past, which is the first criteria. Until Dakota actually works for us, and works for us without getting paid, there cannot be a liability. And even then, the liability would only be for the time that he or she has worked without pay. We wouldn't book a liability for the entire 3-year contract because we haven't received the benefits for that yet. Plus, there's too much uncertainty with that because Dakota could quit tomorrow, we could fire Dakota, our lawyers, his or her lawyers, could find a way out of the contract. There's too much uncertainty over the dollar amount for the 3-year contract. So we only are going to record a liability for the amount of time that Dakota's worked for us. Since he or she hasn't worked for us yet, there would be no liability. BOC has not yet paid employees who earn salaries of $1 million during the most recent pay period. This would be a liability, which we're going to call salaries payable.
So
It does
they
meet
work
the
for
first
you
criteria
already.
because there's an
You
obligation
haven't
based on the
paid.
benefits we've received. The employees have worked for us, we've gotten the benefit of their services, and now we have an obligation to pay them for those services. The amount we owe is reasonably certain, and again, if there were any questions, the employees would surely let us know how much we owe them. So we'd have an obligation based on past benefits for $1 million, and we'd book a liability called salaries payable for $1 million.
In both of these last two examples, we have not yet paid our employees. Why is this one a liability, but not the previous one? Is it because the first one pertains to an executive, whilst the
First one
second one pertains
doesn't
to
have
lowly
work.
employees?
Second has.
No, it has nothing to do with status. It's simply a matter of, for a liability to exist, there must be some obligation based on benefits or services received in the past. Employees that have worked for us without being paid creates a liability for us. Employees that have not yet worked for us cannot create a liability. BOC borrows $500,000 from a bank on a 1-year note with a 10% interest rate. We talked about this example earlier. This would be a liability called notes payable. Meets the first criteria because we have an obligation based on receiving the benefit
years,
of the
we don't have to pay for
$500,000
the
from
interest
the bank.
yet.
The amount that we owe is reasonably certain. It's $500,000, so it meets the second criteria. So we'd have a liability called notes payable for $500,000.
What about the interest? We will owe interest on the
Doesn't
loan.
incur yet.
Shouldn't there be an interest payable as well?
Great question. Interest is not a liability at this point because we just took out the loan, and we could presumably pay it back right now without owing any interest. Interest only becomes a liability as the money is outstanding over time, and to the extent that we haven't paid it, the amount of interest that we owe but haven't paid becomes a liability. Finally, BOC is sued by a group of customers who claim their products were defective. The suit claims damages of $6 million. This would not be a liability. It does meet the first criteria. There's a potential obligation based on a benefit received in the past. The benefit was we sold products which turned out to be defective. Doesn't meet the second criteria, though, because we can claim that the amount of the payment is still uncertain. Until we have a settlement or we go to trial, we don't know whether we have to pay anything. So because of that uncertainty, we don't have to record a liability in this case. Finally, we have stockholders' equity. Stockholders' equity is the residual claim on assets after settling claims of creditors. In other words, it's assets minus liabilities. A lot of synonyms for this. It's also called shareholders' equity, owner's equity, net worth, net assets, net book value. Unlike assets or liabilities, there are not two criteria for how to measure stockholders' equity, because if you measure all your assets correctly and you measure all your liabilities correctly, that stockholders' equity is whatever's left over. But there are two sources of stockholders' equity. The first source is what we call contributed capital, which arises from selling shares of stock to the public. So we'll talk about common stock and additional paid-in capital. That's what you record when you issue new shares to the public. Common stock is for the par value. Additional paid-in capital is for everything you receive above the par value. And then treasury stock is what we call it when the company repurchases its own stock from investors.
Wait, what is this thing called par value? Is this why there are so many accountants on the golf course during the day?
I'm not sure why you're seeing so many accountants on the golf course, but it has nothing to do with par value. Par value is this archaic historical concept. There used to be laws which said that companies couldn't issue new equity if the value of their stock was below the par value, or they couldn't pay dividends if the value was below the par value. Most of those laws are gone now, and par value's main implication is that when we issue equity, we put the par value amount of the proceeds into an account called common stock. We put the rest into additional paid-in capital. You'll see this more in subsequent videos. The other source of
contributed capital, common stock. There's no paid-in capital.
Stockholders' equity is retained earnings, which arise from operating the business. Retained earnings is the accumulation of net income, which is revenues minus expenses, less any dividends that have been paid out since the start of the business. So what are dividends? Dividends are distributions of retained earnings to shareholders. They're not considered an expense, and we record them as a reduction of retained earnings on the date the board declares the dividend, which is called the declaration date. If we don't pay in cash on that date, which is what usually happens, it will create a liability to our shareholders until we actually pay the dividend on the payment date.
Excuse me. Please explain that again. Why are dividends not an expense? They are paid in cash like other expenses. And why are they a liability?
Both great questions. First, dividends are not considered an expense because they're not considered a cost of generating revenue. Instead, dividends are a discretionary decision by the board of directors to return some funds back to shareholders that's presumably somewhat independent of the company's performance or sales during the period. Second, we created dividends payable because once the board declares a dividend, it's essentially holding the shareholders' money until it sends the check, making the shareholders creditors of the company. Now, I admit this one seems weird because usually liabilities are for non-owners, whereas here we have a liability to our owners, but we consider them creditors in this one specific case. The best thing at this point is just to memorize it. Dividends are not an expense, and when the board declares but doesn't pay a dividend, we create a dividend payable liability. And that wraps up our discussion of assets, liabilities, and stockholders' equity. Now we have to figure out how to keep track of them. Well, the good news is in the next video, we'll talk about those magical things called debits and credits, which will help us keep track of everything in the financial statements. See you then.
See you next video.
You will come back through and daddy. Accounting. Resident sleeper. I mean, I do agree that a lot of this sounds really basic, but sometimes it's necessary to get through this one so I can understand stock markets better. Please tell us how you have understood content. What the fuck? I don't care. I don't care
Hello, I'm
about
Professor
getting
Brian
credits
Boucher.
for
Welcome
this.
back. This is the video you've all been waiting for. We're going to talk about debits and credits. Now, I have to admit that there's somewhat of a disagreement in the accounting faculty world about whether we should still be teaching debits and credits. I am firmly in the camp where I believe that debits and credits are a very useful and powerful tool for learning and teaching accounting. Plus, I still use them to this day. If I had to figure out some kind of complicated transaction in a financial statement, first thing I would do would be break out the debits and credits to help me crack the problem that I'm trying to solve. So hopefully you'll find them useful too. If nothing else, you're joining an exclusive fraternity of people around the world that can speak in the language of debits and credits. Let's get started. As a starting point, I have to say that the most interesting thing about bookkeeping is that it's the only word in the English language with 3 consecutive sets of double letters, O-O-K-K-E-E.
Wow.
Beyond that, I'm not sure it's that interesting, but these 3 fundamental bookkeeping equations I'm going to show you are incredibly powerful tools for both learning accounting and then ultimately understanding the information that you're going to read in financial statements. The first equation we've seen before, assets equals liabilities plus stockholders' equity, the balance sheet equation. We're also going to introduce the equation that the sum of the debits has to equal the sum of the credits, and that the beginning balance of an account plus increases minus decreases has to equal the ending balance in an account. These 3 equations must balance at all times. And this will come in handy because many times we'll be missing one piece of information, but we'll have everything else. And then we can use one of these equations to figure out the piece of information that we're missing. We're going to recognize that the balance sheet equation can be preserved through the use of debits and credits. So instead of having to constantly go back and recalculate the balance sheet equation, instead all we have to do is make sure our debits equal our credits and we know that the balance sheet equation is preserved. So what are these magical things called debits and credits? A debit is defined as a left side entry, and a credit is defined as a right side entry.
Doesn't credit mean good? Credit my account. Credit card. Credit to society. All sounds good to me.
And doesn't debit mean bad? Debit card. Debit my account. Debit to society. I hate the word debit.
Yes, debit and credit have gotten those connotations in the real world. But in the accounting world, debit simply means left, credit simply means right. Sometimes debits are good, sometimes they're bad. Sometimes credits are good, sometimes they're bad. All they mean is left and right. And don't ask me why we abbreviate debit as DR. It's probably something the British came up with centuries ago and we've just always done it that way, but that's the way we do it, so get used to it. Now let's take a look at how debits and credits can be used to preserve the balance sheet equation.
Yeah, why?
So here's the balance sheet
It's
equation.
not even the R.
And in prior videos, remember, we did a more complete balance sheet equation where we split the stockholders' equity into contributed capital, retained earnings, and then revenues and expenses.
Where are dividends? In a prior video, you had dividends in this complete balance sheet equation.
Dividends.
I bet you think we aren't even watching the videos we don't participate in.
Nice catch. I did drop dividends from this equation. One reason is that I was running out of space on the slide, as you can see. But the more important reason is we're going to not treat dividends as a separate account going forward. We'll create separate accounts for revenues and expenses, but we're just going to treat dividends as a reduction in retained earnings. The problem with this equation is that we have the negative
1.5 is
expenses
pretty
at
good,
the
I
end.
think.
As we saw a couple of videos ago, it can get confusing when working with expenses in this case, because an increase in an expense would be an increase in a negative number on the right-hand side of the equation, which would make it go down, and it gets very confusing. So to solve this problem, we're going to move expenses to the other side. Now we have assets plus expenses equals liabilities plus contributed capital plus retained earnings plus revenue, and it's all positive numbers. Then we're going to call everything on the left debits and everything on the right credits. There are a number of rules of debits and credits that we have to keep in mind and follow if we want the debits and credits to stand in for the balance sheet equation. First is that every transaction must have at least one debit and at least one credit, which makes sense because if we want debits to equal credits, we have to have at least one on each side in a transaction. Debits must equal credits for all transactions, and as long as that's the case, we'll know that the balance sheet equation will stay in balance. No negative numbers are allowed. So you're going to debit a positive number or credit a positive number. You're never going to debit a negative number or credit a negative number. And as you can see in the balance sheet equation above, now that it's rearranged, we don't need to deal with negative numbers for debits and credits. Now we're going to talk about accounts and account balances. In case you ever wondered, the reason why this is called accounting is because we put everything in these accounts, which are areas where we keep track of similar types of transactions. Every account has a normal balance. That's the type of balance, either debit or credit, that the account carries under normal circumstances. We're going to represent accounts in something called a T account, which is going to show all of the changes in the account value. We're going to put debits on the left side of the T and credits on the right side of the T, and we're going to do that because debit means left and credit means right. The difference between the sum of the debits and the sum of the credits at any point in time will give us a balance for the account. And then the change in account balance equation is the one we saw before. Beginning balance in account plus increases minus decreases has to equal the ending balance, where we're going to use debits and credits to stand in for the increases and decreases. I was wondering why I wasn't getting any questions. Wake up. It's going to get more interesting. I'm going to do some examples now. Okay, let's take a look at how this works in more detail. Assets and expenses are going to have a normal balance that's a debit, which means it's going to sit on the left side of the T account. For example, let's look at an asset like accounts receivable. Remember, this is the money that's owed to us by customers based on sales we've made in the past. It's an asset because it's money we'll collect in the future. Notice I'll put a little A in parentheses to denote that this is an asset account. The beginning balance sits on the left side of the T account because it's a debit balance account. Then let's say during the period, we make new sales of 100. New sales on account increase accounts receivable, increase the amount of cash that our customers owe us, and we're going to increase the account through a debit entry. We increase a debit account with a debit entry. Then when we collect cash from customers, it reduces accounts receivable. The customers don't owe us the cash anymore because they paid us, so the account has to go down. We reduce accounts receivable with a credit. We reduce a debit balance account with a credit entry. Then at the end of the period, we draw a line, add up the debits, subtract the sum of the credits, and we get an ending balance, in this case of 1020, which sits on the debit side because, again, it's a debit balance account.
So, does debit mean good? I mean, new sales are good, right? Or does credit mean good? Cash collections are good, right? I am so confused.
Don't think of debits and credits as good and bad. Debit
Just
simply
look at
means
right.
left entry. Credit simply means right entry. Debits will sometimes increase account. Debits will sometimes decrease an account. It all depends on the type of account it is. So hang on for more examples, but just keep in mind, debit and credit is not good and bad. It's just left and right. Now let's look at accounts that have a normal balance on the credit side. Liabilities, stockholders equity, and revenue have normal balances that are credits, which sit on the right side of the T account. If we look at an example of a liability like accounts payable, this is money that we owe our suppliers based on raw materials that we've received in the past. Put a little L in parentheses to indicate it's a liability because we have an obligation to pay those suppliers in the future. At the beginning of the period, we owe our suppliers $1,000. That beginning balance sits on the credit side because it's a credit balance account. During the year, we pay $80 to our suppliers. That reduces the liability, reduces the obligation. We reduce a liability with a debit. So a debit entry reduces a credit balance account. Also during the year, we go out and purchase new inventory. We purchase it on account, so we owe our suppliers $100. That's going to increase the liability accounts payable. We increase the liability with a credit entry increases a credit balance account. At the end of the period, we draw a line, add up the credits, subtract the sum of the debits. We get an ending balance of 1020, which sits on the credit side or right side because it is a credit balance account.
I think I've got it. Debit means increase for a debit account and decrease for a credit account. And credit means increase for a credit account and decrease for a debit account. Or is it the other way around?
No, you're exactly right. Debits increase a debit balance account and decrease a credit balance account. Credits increase a credit balance account and decrease a debit balance account. Did I say that right? Yeah, I think so. Anyway, let's just go on. One way to represent this graphically is through something we call the super T account. If you think of the whole balance sheet as a big T account with assets on the left and liabilities and stockholders equity on the right, then what you can see is all the individual asset accounts are going to be increased by debits because they're on the left side of this super T. all the individual liability, contributed capital, and retained earnings accounts are going to be increased through credits because they sit on the right-hand side of the super T. Then where it gets a little tricky is revenues and expenses. Remember, revenues and expenses live within retained earnings. Revenues increase net income, which means they increase retained earnings. So revenues have a credit balance. They're increased with credits, which then in turn increases retained earnings. Expenses are reductions in net income and hence reductions in retained earnings. So expenses have a debit balance because a debit to an expense represents a reduction in retained earnings. I mean, there's not much intuition to this. This is just something you're going to want to memorize until it becomes second nature.
Dude, can I get a tattoo of this on my arm?
Yeah, you could, but maybe a less drastic step would be to just print out the slide or maybe write it on your hand with an ink pen. But I do think it is a good idea to keep a cheat sheet handy to help remind you which accounts are debit balance accounts and which accounts are credit balance accounts until you have it memorized. We're going to follow a very systematic approach in analyzing transactions to figure out how to represent them as journal entries. Journal entries are what we're going to use to show a transaction in this debit and credit format. So there's 3 questions we have to think about. First, what specific asset, liability, stockholders' equity, revenue, or expense accounts does a given transaction affect? Does the transaction increase or decrease the affected accounts? And then should the accounts be debited or credited? And here we can look back to something like the Super T account as a cheat sheet to figure out whether we debit or credit to increase or decrease the accounts. Then we can put it in the journal entry format, which is our shorthand for what happened in the transaction. We start with the debit account. We use the abbreviation DR for debit, the name of the account, and the dollar amount. Then we list the credits after that. We indent the credits, put a CR for the abbreviation, the names of the accounts credited, and the dollar amount. The key thing to remember is always list your debits first, then list your credits, and then always indent your credits. Okay, this is really important. Raise your right hand and repeat after me. I do solemnly swear that I will always list my debits first.
I do solemnly swear that I will always list debits first.
That I will always list credits second.
That I will always list credits second.
And that I will always indent my credits.
And that I will always indent my credits.
Did I just ask you to swear an oath about debits and credits? I think maybe I'm getting a little loopy here, so why don't we go ahead and stop the video at this point. We'll pick it up in the next video with a series of 4 examples to help pull together everything we've talked about so far, and then we'll practice doing some journal entries. I'll see you then.
See you next video.
Hello, I'm Professor Brian Boucher. Welcome to the second part of our debit and credit extravaganza. In the last video, we introduced a lot of terminology and concepts, and in this video, we're going to practice applying those. I'm going to start with a series of examples to help review the key concepts from last video, and then we'll move on to practice doing journal entries so that we get used to writing things using this debit and credit language. Let's get started. Okay, let's reinforce everything that we've learned with a series of 4 examples. In the first example, we're going to increase an asset and then increase either a liability or equity. In this case, we receive $100 cash from a bank loan. The accounts involved are cash and notes payable, both of which increase by $100. On the balance sheet equation, we would see that assets would go up by 100, that's the cash. Liabilities would go up by 100, that's the note payable or obligation to the bank, and equity is unchanged. For the journal entry, first we need cash to go up by 100. Cash is an asset. Assets are debit accounts, so we would debit cash to get it to go up by 100. And what I'll do is I'll put in parentheses plus A to indicate that this debit is increasing the cash account. We're going to credit notes payable for 100. Notes payable is a liability. Liabilities are credit accounts, so we increase a credit account with a credit entry. If we looked at this with T accounts, we would have a cash T account, which would have an entry on the debit side, a notes payable T account, which would have an entry on the credit side. If we did a balance sheet equation, sort of drew a line, added up the balance in each account, our balance sheet would balance. We'd have cash of 100 on the asset side, liabilities of 100 on the liability and equity side with no shareholders' equity. Another example. Now let's look at decreasing an asset and decreasing a liability or owner's equity account. So here we're going to repay $20 of a bank loan. So the accounts involved are cash and notes payable. Both are going down by 20. On the balance sheet equation, we would see assets go down by 20, that's the cash. Liabilities going down by 20, that's the notes payable, and there's no effect on equity. For the journal entry, we're going to debit notes payable for 20. We need a liability to go down. Liabilities have credit balances. We reduce a credit balance with a debit notes payable 20. Then we're going to credit cash for 20. Cash is an asset. Assets are debit balances. We reduce a debit balance accounts with the credit, so we credit to cash for 20, we'll reduce it. And notice I have minus L and minus A in parentheses to indicate that these two are both reducing liabilities and assets. For T accounts, we would have a credit entry in the cash T account, a debit entry in the notes payable T account. If we drew a line for the balance in each, our balance in cash is 80 on the debit side, balance in notes payable is 80 on the credit side. Our balance sheet equation would balance where we have 80 of cash, 80 of notes payable, and no stockholders' equity. Okay, I know we're not off to a rousing start, but just 2 more examples and then we'll do some journal entry practice. Next example, let's look at increasing one asset and decreasing another asset. The example transaction is that we pay $10 in cash for inventory. The accounts involved here are cash and inventory, and cash is going down by 10. Inventory is going up by 10. Our balance sheet equation would look like this. All the actions on the left-hand side where we have one asset going down and one asset going up by the same amount, so they cancel. For the journal entry, we need inventory to go up. Inventory is an asset, so we debit inventory by 10 to make it go up by 10. We need cash to go down. Cash is a asset. You make a debit balance asset account go down with a credit, so we credit cash for 10. In terms of the T accounts, we would have another credit to cash of 10. we would put a inventory T account with a debit balance of 10. If we drew lines and added up the balances, we've got 70 in cash and 10 in inventory on the left-hand side, so that's 80 of assets. We have 80 of liabilities in the notes payable, no stockholders' equity, our balance sheet's balance, and our debits equal our credits. Final example, we're going to increase a liability or equity and then decrease another liability or equity. So in this case, we're going to issue $80 in common stock to pay off the bank loan. So the two accounts are common stock and notes payable. Common stock is a stockholders' equity account going up by 80. The bank loan's a liability going down by 80. In the balance sheet equation, we'd have nothing on the asset side. Liabilities would go down for paying off the bank loan. Equity would go up for issuing the common stock. For the journal entry, we want to debit notes payable for 80 because notes payable is a liability that we want to reduce. Liabilities have credit balances. We reduce them with a debit, so debit notes payable. We want common stock to increase. Common stock is an equity account which has a credit balance. We increase a credit balance account with a credit. So we credit common stock to increase stockholders' equity by 80. And then with our T accounts, we would have a reduction of 80 to notes payable, the reduction being a debit, an increase to common stock of 80 with the increase being a credit. If we drew lines and came up with the totals, we'd have 70 in cash, 10 in inventory, that's 80 on the asset side. We have no notes payable, it goes to 0 because we fully paid it off, and a balance in common stock of 80, so our assets equal our liabilities plus stockholders' equity, balance sheet balances, debits equal credits. So let's practice some journal entries. It'll be the same procedure that we've used in other videos where I'll give you a transaction, put up the pause sign so that you can pause if you want to give a shot, then I'll give you the answer and we'll talk through how we got it. Here's the first one. BOC issues 10,000 shares of $5 par value stock for $15 of cash per share. In this transaction, we're receiving cash. Cash is going to increase, and we're going to increase common stock accounts. Cash is an asset. We make cash go up with a debit, so we're going to debit cash. The dollar amount is $150,000, which is $15 cash times 10,000 shares. We need the common stock accounts to also go up by $150,000, but we have to split it between the par value and the additional paid-in capital. So we're going to credit common stock at par for $50,000, which is $5 par value times 10,000 shares, and then we'll credit additional paid-in capital for the rest, which is $100,000. So now we have $150,000 of debits, $150,000 of credits. We're in balance, and we've done the journal entry correctly.
Whoa. You can have more than one credit in a journal entry. Could you also have more than one debit?
And what is this also shown with par value?
Yes, you can have more than one credit. You can have more than one debit. The only requirement is that your debits equal your credits within the journal entry. And yes, accounting professors are obsessed with par value. It's one of those difficult things that you can only come to a trained professional like me to understand, so you're going to see it a lot. BOC acquires a building costing $500,000. It pays $80,000 cash and assumes a long-term mortgage for the balance of the purchase price. The accounts involved in this transaction are buildings, which are going up, cash, which is going down, and mortgage payable, which is going up. It's a liability that's increasing as we take out the mortgage. So starting with buildings, they're going up. Buildings are an asset, so we debit buildings by $500,000 to increase the asset. We want cash to go down. Cash is an asset. Cash has a debit balance, so to make it go down, we need to credit it. We credit cash for $80,000 to reduce that asset. And then mortgage payable is a liability, has a credit balance. We want to increase it, so we're going to credit mortgage payable to increase the liability. We're not given the amount, but we know it has to be $420,000 because we know our debits have to equal our credits. Once we credit mortgage payable for $420,000, we have $500,000 of debits, $500,000 of credits, and we're in balance. BOC obtains a 3-year fire insurance policy and pays the $3,000 premium in advance. In this transaction, we're getting fire insurance coverage for 3 years. That's an asset that we're going to call prepaid insurance, and it's going up. We're paying cash, so cash is going down. So starting with the prepaid insurance, it's an asset. We make an asset go up through a debit, so we debit prepaid insurance for $3,000. Cash is an asset also, but it's going down. So to make cash go down, we credit cash to reduce the asset by $3,000. BOC acquires on account office supplies costing $20,000 and merchandise inventory costing $35,000. In this transaction, we're acquiring office supplies and inventory. Both of those are assets, so we're going to make them go up with debit. So we debit office supplies to increase that asset by $20,000. We debit inventory to increase that asset by $35,000. Now we're not paying any cash. Instead, we owe our supplier $55,000 because we got this stuff on account. When we owe money to our supplier, it's a liability called accounts payable. That's increasing. We make a liability increase through a credit, so we credit accounts payable for $55,000. So we have $55,000 of debits, $55,000 of credits, and we're in balance. Next, BOC pays $22,000 to its suppliers. In this transaction, we're paying our suppliers, which reduces how much we owe them, which is going to reduce accounts payable. And since we're paying cash, it's going to reduce cash as well. Accounts payable is a liability. It has a credit balance. If we want to reduce it, we need a debit. So we debit accounts payable $22,000. Cash, of course, has a debit balance. If we want to reduce it, we credit cash for $22,000. And this, by the way, is the journal entry you're going to do anytime that you pay cash to reduce a liability. Debit the liability to reduce it, credit cash to reduce it. BOC exchanges a building valued on the books at $200,000 for a piece of undeveloped land. In this transaction, we're trading one asset for another asset. We're getting land. Land is going to go up. So to make land go up, we debit land, 200,000. We're getting rid of a building. Building is going down. Building is an asset. We make an asset go down with a credit, so we credit building 200,000.
How do you know that the land is worth $200,000?
Given the information we have to assume the land is worth $200,000, so our debits equal our credits. And the assumption makes sense because if we're giving up a $200,000 building and just getting land, the two values should be equal. Now later on in the course, we'll look at situations where they're not equal and we end up having a gain or loss in the transaction, but that's for another day. BOC retires $1 million of debt by issuing 100,000 shares of $5 par value stock.
So
in this transaction, we're reducing a liability. Anytime we reduce a liability,
extra.
we need to debit the liability to make it go down. So we debit notes payable for $1 million to reduce it by $1 million. Now we need to increase stockholders' equity by $1 million, but we have to split it into the common stock and the additional paid-in capital. So common stock at par goes up by the par value. So we credit common stock to make the stockholders' equity go up for $500,000, which is 100,000 shares times $5 par value. Then we credit additional paid-in capital to make that stockholders' equity account increase. And we know the amount has to be $500,000 because we know our debits have to equal our credits. Sorry, I'm going to make you do par value a lot. Get over it. BOC receives an order for $6,000 of merchandise to be shipped next month. The customer pays $600 at the time of placing the order. In this transaction, we're receiving $600 cash. Anytime we receive cash, we debit cash to increase the asset, so we debit cash $600. We're also getting an obligation here because now we either owe the customer $600 back or we have to deliver the merchandise. So we're going to create a liability called advances from customers. So we credit advances from customers to increase the liability for $600.
What about the $6,000 of merchandise we ordered? Don't we have to account for that?
No, we only account for the $600 because that's the only part where there's been a transaction exchange because we received $600 cash. For the other $5,400, that's all future stuff. That's all promises. We don't have a liability yet because there's no obligation that's based on benefits or services that we've received. Not until we exchange cash, goods, or services equal to $5,400 in the future will we have to record that part of the transaction. Finally, BOC declares and pays $8,000 of cash dividends. Let's start with cash in this transaction. So cash is going down by $8,000. Anytime cash goes down, we credit cash to reduce the asset. So we credit cash for $8,000. So now we know we're looking for a debit. The other part of the transaction is dividends. We're paying dividends. Now remember, dividends are a reduction in retained earnings. Retained earnings are a stockholders' equity account. Stockholders' equity accounts have credit balances, so we reduce them with a debit. So we reflect the dividend by debiting retained earnings for $8,000. That was a lot of good practice at taking transactions and trying to represent them as journal entries using debits and credits. You're going to get a lot more practice. Starting next video, we're going to do an extended case that follows a startup company all the way through its first transactions to its first set of financial statements. And along the way, you're going to get a lot of practice doing journal entries and see a lot more debits and credits. I'll see you then.
See you next video.
It was boring.
Hello, I'm Professor Brian Boucher. Welcome back. Starting with this video, we're going to look at an extended case study which will illustrate the accounting cycle. The accounting cycle is all the steps that you have to follow to go from recording transactions all the way through preparing financial statements. The case is going to be spread out over a number of videos, interspersed with new topics that we introduce, which will then illustrate in the case study. Let's get started. Let's start off with a quick review. So we've seen in the last couple videos how journal entries and T accounts can be used to track and record the effects of transactions. And the key is to make sure that our debits equal our credits when we record these journal entries. And if we do so, then we know that the balance sheet equation will hold when we add everything up. So the debits and credits substitute for the balance sheet equation. We talked about how debit means left side entry and credit means right side entry.
So, when I buy something at the store and the cashier says debit or credit, should I point out that he is really asking left or right?
Please don't say that. You're going to get me in trouble. To make sure that debits and credits will preserve the balance sheet equation, we set assets and expenses to have debit balances, which means that debits will increase these types of accounts and credits will decrease them. We set liabilities, shareholders' equity, and revenues to have credit balances, so that credits will increase these accounts and debits will decrease them. We also looked at a visual picture that we could use to remember this, the Super T account, which shows whether debits or credits increase or decrease the various type of accounts, and talked about how you should print this out to
Expense is the only
memorize it
weird one.
or tattoo it on your arm, whatever your inclination may be. Now we're going to talk about the accounting cycle.
Just because it's minus.
Woohoo! Let's take a ride on the accounting cycle.
It's not that kind of cycle, but it should be just as fun. We're going to go through the entire accounting cycle with an extended case, which follows a startup company from its first set of transactions all the way through its first set of financial statements, and that's what the accounting cycle is set up to do. First, as the business is operating during a fiscal period, transactions happen, and then you have to analyze those transactions to figure out how to come up with journal entries and then post those journal entries to T accounts. Once the period is over, we do something called an unadjusted trial balance to make sure we haven't made any math mistakes or transposed any numbers. Then we do something called adjusting entries, which are needed to get the books correct before we do financial statements. After another trial balance, we prepare the financial statements. When we're done with those, we have to do something called closing entries, which gets us all set to start the new period so that we can do this over and over and over and over and over and over again through the whole life of the business. We're going to start the case with the first part of the accounting cycle where we analyze transactions and then figure out how to journalize them, which is record each transaction as a journal entry in something called the general journal. Then we're going to post that journal entry to T accounts or general ledger, where we'll keep a running total of the balance in all the accounts. So now let's take a look at the facts of the case. In March of 2012, Rebecca Park identified an excellent business opportunity while she's a first-year MBA student at Wharton. She read a story about an MBA student who tripped while jogging in Fairmount Park and found an ancient gold coin in the underbrush. It was an old Viking coin that was appraised at $77,500. She realized she could set up a profitable business that rented out portable metal detectors to people that wanted to search Fairmount Park for more Viking relics. Also, Park had the idea of stocking her store with sundries, such as water bottles and energy bars, that she could sell at a huge markup to renters before their expedition into the park. Park prepared a business plan and approached a fellow student, Jay Gerard, who had a sizable trust fund and who she believed would invest in this new venture. Due to his myriad of other investments and his heavy course load, Gerard agreed to invest as a silent partner and allow Park to run the business, which she named Relic Spotter Incorporated. So now what we're going to do is go through a number of transactions for the company. After each transaction is read, you should pause the video and try to do the journal entry. Think about what accounts are involved, did they increase or decrease, and then do we debit or credit. Then resume the video to see the answer and the explanation, and that's when we'll post the journal entry to T accounts. First transaction. On April 1st, 2012, Gerard decided to invest $200,000, and Park put up $50,000 to purchase a total of 25,000 shares in the new company. The par value of the shares was $1. In this transaction, we're receiving $250,000 of cash for issuing
par value.
Cash is increasing by $250,000.
$9 was the additional
we increase
value.
assets through debits, so we're going to debit cash for $250,000 to increase this asset. We also have a $250,000 increase in contributed capital, which is stockholders' equity. But remember, we have to split this into two parts, the par value and the additional paid in capital. So first, we have common stock at par, which is going up by 25,000 shares times $1 or $25,000. We make stockholders' equity go up with a credit, so we credit common stock for $25,000. And then we credit additional paid in capital for the rest, $225,000, which is the number we need so that our debits equal our credits.
Excuse me, are you allowed to have more than one credit in a journal entry?
The par value again.
Yes, you can have more than one credit and or more than one debit. As we talked about last time, the only requirement is that your debits equal your credits. And it looks like the par value guy is back again, and you're going to have to deal with par value a lot, so get used to it. After we do the journal entry, we need to post these amounts to T accounts where we can keep a running total of the balance in each account. So we create a T account for cash, put the $250,000 on the debit or left-hand side. We put a little 1 there so that we can trace this number back to the original journal entry in the general journal. We create a similar T account for common stock. Of course, the balance is on the credit side, and the same thing for additional paid in capital. Transaction 2. Lacking the funds for her initial investment, Park borrowed the $50,000 from the Imperial Bank of Philadelphia on April 1st, using her parents' house as collateral. The journal entry for this one is, well, there is no journal entry. Because Rebecca Park is borrowing the money personally, it's not Relic Spotter that's borrowing the money. In other words, Relic Spotter doesn't have to pay this loan back, Rebecca Park does. So there's something called the entity concept, which says the only thing that should go in a company's books are transactions for the company, not transactions for the employees. So we want to keep this separate. Rebecca Park's loan, personal loan, does not show up in the Relic Spotter books. Now, having said that, this is the only time I'm going to do this trick. In the rest of the case, I'll talk about Rebecca Park does this, Rebecca Park does that. But for the rest of the case, she's doing things on behalf of the company. So you're not going to see this trick again. Since there's no journal entry, there's nothing to post to T account, so we can go right on to transaction number 3. On April 2nd, Park hired a lawyer to have the business incorporated. Because this was a fairly simple organization, the legal fees were only $3,900.
Legal service of 3900.
So let's take a look at the journal entry. I always recommend starting with cash if there's cash involved in the transaction, because you'll quickly memorize whether to debit or credit cash based on whether you receive or pay cash. So in this case, we're paying $3,900 of cash for legal fees, which seems quite exorbitant, but I guess it's lawyers, so what are you going to do? Anyway, if we're paying cash, cash is going down. Cash is an asset, so assets go down through credits. So we're going to credit cash for $3,900. Now notice, even though I started with cash and it was a credit, I don't write it first in the journal entry. As we talked about in a prior video, you always want to write debits first, so I had to skip some space, write the credit second, and indent it. So now we need to find a debit. So what are we getting for this cash? We're not really getting an asset. This is more of just a cost of doing business. So it's going to be legal fees expense. Remember that expenses get increased through debits. So we're going to debit legal fee expense, which will increase expenses and reduce stockholders' equity by $3,900.
Excuse me, why isn't this an asset?
I guess you could say this is an asset because the future benefit is that we get to operate the business forever once we've incorporated it. It's a pretty lame rationale, but there were companies that used to call this an asset. Now the rules are explicit. This kind of expenditure.
So alert. Gotta make sure. Cyber Crystal City. Thanks for the follow. Study every day, improve every day. 1 hour a day. Keeps low salary away. Welcome.
Has to be expensed immediately. Let's post this to T account. So we bring back our cash T account. We put $3,900 on the credit side or the right-hand side with a little 3 to indicate that it's transaction number 3. And we create a T account for legal fee expense with $3,900 on the debit side or the left side. Next transaction, number 4. To house the business, Park bought an abandoned pizza parlor near Fairmount Park for $155,000 on April 7th. The building was old and needed renovation work. The purchase documents allocated $103,000 to land and $52,000 to the building. Park paid for to house the business. Let's post this to $3,900. Let's post this to T account. So we bring back our cash T account. We put $3,900 on the credit side or the right-hand side with a little 3 to indicate that it's transaction number 3. And we create a T account for legal fee expense with $3,900 on the debit side or the left side. Next transaction, number 4. To house the business, Park bought an abandoned pizza parlor near Fairmount Park for $155,000 on April 7th. The building was old and needed renovation work. The purchase documents allocated $103,000 to land and $52,000 to the building. Park paid for the building with $31,000 cash and a $124,000 mortgage from the Imperial Bank. Wow, this is a big transaction, so it's going to require a big journal entry. I always like to start with cash if we can. We paid $31,000 of cash. Cash is an asset. Assets go down with a credit, so we credit cash for $31,000. We acquired land and building. Land and building are both assets. Assets go up with a debit, so we want to debit building for $52,000 and debit land for $103,000 to make those two accounts go up. Now at this point, our debits don't equal our credits, so we can't stop. We're missing one more piece,
mortgage.
And that piece is the mortgage. A mortgage is a liability. Liabilities go up with a credit, so we need to credit mortgage payable for $124,000, and now our debits equal our credits.
Why do we need to have separate accounts for land and for buildings? And why don't we record interest payable as well? Won't we have to pay interest on the mortgage?
Huh? Those two look like twins. Oh, anyway, both good questions. We keep land and building in separate accounts because later on we're going to do something called depreciation, and these two accounts will be treated differently. As for the interest question, I think we talked about this in a prior video, but it's good to review it. We don't owe any interest when we take out the mortgage. We can pay back the mortgage immediately and not have to pay any interest. Only as time passes and we owe interest without paying it will we have to record an interest payable. We've got a lot of posting to do for this journal entry. We bring back our cash T account and put another credit on the right-hand side. Create T accounts for building and land, and one for mortgage payable. Transaction 5. Park felt that some renovation work would extend the life of the building to 25 years with an expected salvage value of $10,000. She ordered the renovation work, costing $33,000 to begin immediately. The work was completed on May 25th, at which time she paid in cash the amount owed for the renovations.
Credit 3300.
For this transaction, the first thing we're going to do is ignore the stuff about salvage value and 25 years. We'll come back to that in a later video. Instead, we're going to focus on the transaction that happened on May 25th, which is when Park paid the cash. We paid $33,000 of cash. Cash is an asset. We make an asset go down through a credit, so we credit cash for $33,000. So now we're looking for a debit. What did we get for this cash? Well, we added to the building, and so we're going to debit building for $33,000 to increase the balance in the building account. Remember, we make assets go up through debits.
Excuse me, why isn't this an expense instead of an asset? All of the expenses seem like assets to me, and the assets seem like expenses. Oh bother.
Great question. The general rule is if you spend money on maintenance, an expected cost of maintaining the asset, then you would expense it. But if you spend money for a capital improvement, which would be something that would increase the value of the building or how long you plan to use it, then you get to add that to the building account. But don't worry about this now. This is something we're going to talk about in a lot more detail later in the course. Then we post this to T accounts. We add another credit to the right-hand side of the cash account and a debit to the left-hand side of the building account. So now the balance in the building is $85,000. I would tell you what the balance in cash is, but I can't do math in my head, so you'd have to figure that out on your own. Next transaction, transaction number 6. Park phoned a number of metal detector vendors until she found one that was willing to give her a volume discount. On June 2nd, Park purchased 240 metal detectors at an average cost of $500 per unit, so that's $120,000 total. The innovation in the industry is so rapid that Park felt the units would only last for 2 years, at which time they would have no remaining value.
At this moment is only
in this transaction, we're going to again
cash
ignore the 2 years, no remaining value. We'll come back to that in a later video. We need to record the transaction where we paid $120,000 cash to get metal detectors. If we're paying cash, cash is going down. Cash is an asset, goes down with a credit, so we credit cash for $120,000. What are we getting? What's the debit? Well, we're getting metal detectors. Metal detectors are an asset. We make assets go up with a debit, so we debit metal detectors for $120,000.
Wait, why aren't the metal detectors considered inventory? Yes, I thought any merchandise that a company purchases is called inventory.
We only use the inventory account for goods that we buy with the intention of selling as quickly as possible at a markup. We don't call them metal detectors inventory because we intend to keep them for 2 years and use them over and over and over and over again to generate rental revenues. So the metal detectors are more like a piece of equipment than what we would traditionally think of as inventory. Then we post this to T accounts. We add another credit on the right-hand side of cash. Good thing that we raised $250,000 because we're spending it pretty quickly. And we create a T account for metal detectors, which now has a debit balance as an asset. So we're about halfway done at this point, so why don't we go ahead and stop this video, and we'll pick up the case in the next video with the next transaction. I'll see you then.
Excuse me. See you next video.
That's a lot of plus and minuses. Cool. I got too much out of this one, to be frank. But it's time. Cool. That's the stream for today.